Greetings, this is Chapter 7, Video 3. Let's launch. Okay, so the learning objectives for this video are going to be to apply the tax basis, at-risk, and passive activity loss. That's actually, the first one is actually a carryover from the previous video, and we'll talk a little bit about some of that in here. That's why I put this in as a learning objective. We will talk about some of that as we get into this, but I just wanted to give you an idea that we'll be primarily focusing on learning objective 2. So passive investments, typically they're investments in partnerships, S corps, and direct ownership in real estate, rental real estate particularly. And usually these will trigger passive activities. Now, passive activities is defined under Code Section 469, and we'll talk about the 469 loss limitations as we get down to that section of this. Ordinary income from these investments are usually taxed as earned, and then ordinary losses may be deductible if you have sufficient passive income to overcome them. In other words, what happens is they let you build this up, and then once it gets to a certain point, it starts to leak over. And that's why we call these things the 3 leaky buckets. Now, the book calls them 3 buckets. I call them the 3 leaky buckets. And if you watch the video series that I gave you guys in Blackboard on if you go to the Blackboard course, there's 3 additional optional videos. You can learn why I call these the 3 leaky buckets and how that helps to explain this a little bit better. So for tax basis limitations, losses may not exceed an investor's tax base in the activity. Now, what's tax basis? We talked about in a previous video. How much did I pay for the investment? How much income has already been taxed? And how many losses have I already taken are going to affect that tax basis? And again, you see the increases to the basis and decreases, and that pretty much delineates most of this. You'll notice one thing that's not on there is depreciation, because depreciation is an expense that is usually taken. This is one of the times where depreciation is not part of that decrease in basis, because generally you're not going to depreciate your ownership in a partnership. What's going to happen is you're going to have an expense for that over time. At-risk limitations, losses may not exceed the at-risk amounts in the activity. Now, Code Section 465, as opposed to 469, actually deals with at-risk limitations. So what ends up happening is that you're only allowed to take losses up to your risk. Now, how does that risk work out? Well, we talk about this in partnerships significantly because it depends on how much your loan amount is and what kind of loans you have that are going to determine this. But basically, the question is, how much money can you lose? How much money will you lose? If you put $10,000 into this, you lose the partnership, you've got a $10,000 at risk. And so that's what they're going to allow you to do with this. Now, it's not just simply money you put in, it's also pre-tax money that's been earned afterwards, and then also some of the deductions. But there's going to be a difference between things that are allowed to be taken for basis and at risk limitations. And again, I'll go over that in the in-depth video if you want to learn more about it. Basically this is an example. Lon purchased an interest in a limited liability company for $50,000. There's no debt. Lon's share of the loss for the current year is $70,000. How much of this is tax basis? Well, obviously it's the $50,000. So they let you take the $50,000 as it, and then the other part is going to be $50,000. But here's what it says. So $20,000 is going to be loss limited because it's got a $50,000 loss. He can take that $50,000 because the basis is going to allow him to do that. His at-risk amount is $50,000 because they have no debt. Now, if they have debt, they may allow for that to be taken because there's additional, but there's no additional loss limitation limited by Lon's at-risk amount. I wish they didn't use the word lawn, because then I start thinking it's like lawn chairs or something of that nature. I shouldn't be making fun of names, but that one's kind of hard not to do. Anyways, I hope I have no lawns in the class. People get mad at me for doing that. So passive activity, it's applied after the tax basis and at-risk limitations. Losses from passive activities may only be deducted to the extent the taxpayer has income from the passive activities or when passive activity is sold. So this is a little different Usually if you have no basis left over and you have the losses, you're going to lose those losses. If you have no risk amounts, you're going to lose the losses. This is different. You can actually take a loss in excess of your passive limitations if you sell the activity. And the reason why the IRS lets you do that is you still had the loss, and they're going to let you take that as a deduction against that. Passive activity is a trade or business which the taxpayer does not materially participate. What is material participation? According to the IRS, it depends. But there are certain rules that they do have, and they'll have certain examples that they do in the regulations. But it's going to be looked at on a whole facts cases, a whole facts case basis. Sorry, cases. Yeah, that's case basis. Okay. So passive participants in rental real estate and limited partners are generally considered to be passive. So, for example, if me, my brother, and my sister decide to go buy a house and we're going to go rent it out, we all three of us do it together. I'm a partner in a partnership that does a passive activity. Because if you look at Code Section 469, it will actually delineate specifically rental real estate activities as passive unless proven otherwise. Okay. What they do is that, you're generally considered to be passive participants, and as a result of which you'll be subject to the passive loss rules. So other participants are considered passive unless their involvement is regular, continuous, and substantial. Now, again, with rental real estate, it's going to be because 469 says so. The rest of the stuff is going to be mostly facts and circumstances. So there's 7 factors that they talk about. And now they'll give you these 7 factors, but here's the thing. The IRS doesn't solely rely upon this. And so sometimes, and here's the thing, when you're starting out and you're working in this industry, you're going to be like, I don't get it. There's, I need the 7 factors, and the 7 factors will help you get a grip on it. But over time, as you get more experience and get smarter about passive activities, you're going to come to a better understanding of what passive is. I always say passive is a lot like love. You know it when you're in it. And you don't know it when you're not in it and you've never been in it, you kind of is a foreign concept. So there are certain things that they say, these are a couple of them. And there's going to be a couple more on the next slide. Individual participates in the activity more than 500 hours. That's going to be considered active. Individual's activity is more than anybody else's. Generally, because usually the way the IRS likes to do it is that one person is actively participating in this, and then the rest of them are kind of passively doing this. The thought process is, how did you get into this? The 3 of you guys go ahead, spit hands, and say, we're all going to be partners, and we're all going to make a whole bunch of money. We're all going to work hard in order to be able to do this. That, to me, is more of an active participation in the activity than if, for example, I'm going to go start a McDonald's, and I'm going to go ask my 3 buddies over here to contribute 10 grand a piece so that I can get cash. They're passive participants. I'm going into work. I'm flipping burgers. I'm hiring employees. I'm training employees on a day-to-day basis. It's active to me. And that's kind of where we kind of get to that. And that's where it says my individual activities contribute substantially all the participation, which the activity by all individuals, including non-owners. Okay. Also, if the individual participates more than 100 hours and the individual's participation is not less than anyone else's. This kind of gets to what I call the small partnership exception. So if you have a small partnership, you guys are kind of doing some stuff. Maybe you spend about 100 hours or say 150 hours a year. Everyone else just kind of put money in. They're not really participating at all. But the activity doesn't require more than 150 hours in order to run. I'm thinking something like Pampered Chef, Cutco Knives, I think is what their name was. If you do this and you have investors and all that sort of stuff, maybe you do that, but it kind of works out a little differently in that sense. The individual materially participate in the activity for any of the 5 preceding 10 tax years. So if you were a material participant for 5 years in the past 10 years, having 1 year where you go down, say for example, you were pregnant and you have a kid, you take a year off. That doesn't mean any, but you still do a little bit of work with it, but you don't do as much because you're taking care of a kid, getting yourself back to health. That doesn't mean that you're going to get kicked out of this material participation or the active participation simply because you took that year and went down. The individual materially participated in 3 of for personal service activities. So, for example, health, law, or accounting. This is where one of the few times that accounting actually gets a benefit versus normally they're kind of pushed to the side. But that's going to be a very important factor. And then, of course, taking into account all facts and circumstances. This is the catch-all. This is where the IRS can kind of take a look at it and says, look, you don't qualify for number 1 through 6, but by looking at this, we kind of see how this actually leans itself to a material participation. Now, normally the IRS wants it to be passive participation. You're going to have to make an argument for it. And, the question is, can you stand in front of a judge with a straight face, not lying, and tell them that, yes, this is an act of participation and here's the reason why. And then you're going to be able to get rid of it or get over it. All right, so that's all I got to say about today's class. I want to say thank you very much for showing up and looking forward to seeing you in the next class.